Hello and welcome to the latest Insider interview. Our guest today is Marcel Stötzel, manager of the Fidelity European Fund. Marcel, thank you very much for coming in.
Thanks for having me, Sam. Great to be here.
You're investing in European shares, not UK shares. Something you said before is that European shares don't mean you're investing in the European economy. What did you mean by that?
I think it's a very important point. This is a stat that often surprises people, but only 1/3 of the MSCI Europe's revenues come from Europe, which obviously means 2/3 of the index's revenues come from outside Europe. So places, you look at a place like the US, for example, is around 25% of MSCI Europe's revenues. The US is almost more important, almost equally important, should I say, to European companies as their home region of Europe, which I think a lot of people, wouldn't kind of think off the top of their heads. And to be honest, Europe is quite unique globally in terms of having that kind of much more abroad versus domestic mix.
And that must be a positive for the fund then. If Europe goes through a recession, actually earnings might be protected.
Exactly, and that's, if we look over the long term, here's another really interesting stat. So if I look at the 30-year history of the trust, for example, and if I look at MSCI Europe versus the world over that time period, the MSCI Europe has actually held up and has been pretty much in line with the world, MSCI world. And if you think about everything that's happened over that time period, if I asked you, what has happened to Europe over the last 30 years, you probably have a number of, negative things to say, Brexit, Grexit, Eurozone crisis, migrant crisis. If I said to you what's happened to the world over the last 30 years, you'd probably have a lot of positive things to say. You'd say the US has been great, China has emerged, India has emerged, etc., etc. But actually, humble Europe has kept pace with that. And I think the reason for that is European companies have benefited from the rise of China, from the rise of India, from the continued rise of the US, almost as much as those domestic companies have.
And why should investors own a Europe fund, having a dedicated manager pick shares there?
I think it's really the valuation differences. If you believe, as I said, that European companies are global, just like any other, then the valuation differences, particularly between US and European companies, starts to become quite stark. You can look at kind of equivalents, kind of Boeing versus Airbus, or Estée Lauder versus L'Oreal, or even just more as a general theme. Back to my earlier point, Europe is not a graveyard index, but actually even more than that, Europe is actually a very nice stock picking index. It doesn't have the high concentration that US has. There are a number of really good managers. Governance is typically very good in Europe, sometimes even better than in the US. So there are really kind of pockets of fantastic companies that you can often get at a discount to if they were listed in the US.
Can we put some figures on the valuation gap with the US? Relatively, how much cheaper is it to own European companies versus similar American ones?
It's a very hard question to answer because you need to adjust for kind of difference in sector allocation. So, European companies are less tech heavy, less growth heavy, which is obviously in favor right now. So it's a tough question to put exact numbers on. An example might be, the granolas, which Goldman came up with. I'm not a massive fan of that nickname, and it's a bit of a hodgepodge of companies. But nonetheless, if you compare the granolas to the Magnificent Seven, they're trading at a similar level of growth, but I can't remember off the top of my head, 4 or 5 times less PE multiples than the Magnificent Seven. And while it's not my favorite acronym, as I say, I think it does highlight that the valuation differential when you try and do it on a like-for-like basis.
And these leading European companies, the granolas, so how many of those do you own? And can you explain why they are genuine world leaders?
So we own roughly around half. ASML, Novo, we've touched on a little bit. LVMH, we've touched on. And SAP, we also own. So we own roughly half of them. They're just businesses that the common thread between all of them is just businesses that can stand on their own 2 feet, really compete head to head on a global stage with whoever the competitors are, and really win. ASML has no competition. They're head and shoulders above the rest. LVMH, is head and shoulders above any kind of other luxury good company besides perhaps Hermes, which is also European. So I think that's what the kind of key to granolas, and what we feel is the key to a number of European stocks. If you can find them, they can really go head to head and win versus any global peer.
Compared to the UK, what types of sectors and companies are you getting in a Europe fund versus a similarly managed UK fund, perhaps?
The main difference is just the kind of sector breakdown. So UK tends to be a lot more natural resources, a lot more banks kind of heavy, whereas if you look at Europe, it tends to be more tech heavy, more kind of industrials heavy, more luxury goods, more autos. So really kind of just those sectoral difference. The UK tends to, for that reason, be a much more of a value type index, and the Europe tends to be more of a growth index, not as much as the US, obviously, but along that continuum. Yeah.
And you manage an investment trust as well, Fidelity European.
Yes.
Is that managed in the same way? How is that different? What would you say about, if you should invest in the trust or the fund? What are the differences there?
The difference is the trust has gearing. So, we gear up 115%. And the reason we do that is, we believe that markets over time will rise, and we want our investors to get the benefit of that gearing and to get that additional kind of kicker, if I can call it that, through time. The second difference is that we can shorten the trust. So we do have some short positions from time to time. Sometimes we don't, and we have one right now. So yeah, other than that, on a name count basis, on a name basis, should I say, they're identical. It's really just a question if you want slightly more risk for potentially more reward in terms of higher gearing and the ability to short, in which case you would go for the trust. If you wanted kind of the really core defensive position nature that I mentioned earlier on, then you would probably go for the open-ended vehicle.
And that short position at the moment, I've got to ask, what is it?
Unfortunately, we cannot disclose short positions. But it's an industrial company, yeah.
You don't hold any cash in the portfolio. So why is that?
We've learned, similar to the comment that I made around, wanting to get the benefits of the fact that markets go up over time in the trust. In both the trust and the OIC, we don't want to have a material cash drag. It doesn't sound like a lot, but if markets over the long term are going up 10% per year, who knows if that will continue, but just to make an example, and you hold 2-3% in cash, that's a 20-30 bips drag that you're getting year after year after year after year. Some people are smart enough to kind of time it and then raise the cash allocation and lower the cash allocation to kind of time the market. We, are an order of magnitude not smart enough to do that. We stick to what we think we're good at, which is stock picking, and leave timing the market and playing around with the cash to other people.
And you're a stock picker, but is there anything happening in the macroeconomic environment which is creating an opportunity at the moment as a stock picker?
It's a bit of a tough environment for opportunities right now. I'd say we're a bit cautious. I'd maybe answer the opposite side of that there's some things that are actually making us more cautious and that we're trying to dial down more on, rather than looking on the other side that after the market has done well and seemingly at one point soft landing was the base case. One thing that we are adjusting on the cautious side is leverage. If you think of what's happened, if you cast yourself back, imagine you're a CFO in 2020, the depths of COVID, the world is falling apart, interest rates are at zero. What would you do? You would fill your boots with as much fixed rate debt as you could get your hands on. If you need it, great, you have it. If you don't need it, you could just pay it back. And what that means is that a lot of that fixed rate debt, just like somebody with a home with a mortgage that's fixed, hasn't really seen the impact of higher interest rates. And that kind of will typically roll off back end of this year into early next year, because it'll typically be 4 to 5 years fixed. And what that means is we believe, from a macro point of view, but more importantly for us as stock pickers, that companies with high leverage might be in for a bit of a shock, because even if it's a utility that's not going to go bankrupt, we think investors and the market might be shocked when all of a sudden in a year's time you get a big jump in that interest income and interest expense line, should I say. So we've been dialing back companies with high leverage over the last few months.
And finally, the question we ask all of our guests: do you personally invest in your portfolio?
I don't, for the simple reason of diversification. So if I look at my kind of personal balance sheet, all of my kind of long-term earnings as well as short-term earnings are heavily tied to this fund already. So in the same way as in my personal investments, I don't invest at all in Europe. All of my personal investments outside of this fund are in Europe, in US, Asia, or outside, to try and diversify myself away. In the same way as we would do if we, for whatever reason, had big, Germany overweight or big industrials overweight, we would try and manage that. I try, to use my non-fund exposure to manage that diversification too.
Marcel, thanks very much. It's been great talking to you.
Thanks a lot for having me, Sam. Much appreciated.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.